This is a video I've wanted to make for a while, an options for beginners video that cuts out all the garbage and nonsense. Options are not a get-rich-quick strategy for me. They're a tool. And if you use the process that I'm going to teach you today, it can help you manage risk, generate income, and make smarter decisions in the stock market. There's a lot of bad information here on YouTube about options, and that's exactly why we need to talk about this and talk about this now. Okay, so I know the word options may sound confusing. You might hear it and immediately think that's for the Wall Street guys. The way we teach and use options is not about getting rich quick. It's a process-driven, principle-based way to use options the right way to generate steady income on stocks you already own or generate income on stocks you want to buy at lower prices. It's not flashy. You're not going to hit home runs. But that's not the goal. The goal is to build wealth slowly and predictably, like a real investor. Because if you can add a few percentage points every year to your returns, you know how much that can change, and I will go through that very shortly. Here's the truth. Most people use options dangerously because they don't understand what they're doing. They're trying to guess and gamble, hit a home run, but unfortunately, most times, without the right process, they end up losing money very quickly. That's not what we're teaching here. What I'm going to show you today is simple, but requires repetition. So if you've been hearing the word options and you've been curious, or maybe a little nervous, that's good. That means you're probably ready to learn this the right way. And if after this video, you still want more help, we've got a full options class where we walk through all of this step by step. But let's start with the basics because you've got to learn this at some point. Learn it now, no matter where you are in your investing journey. Because I don't want you to get to the point where you're like, yes, I need this, and you haven't learned it yet. Now, I want you to think about this. If you use options the way we do, and if you're able to generate just an extra 2 to 4% per year in returns on your stocks from selling covered calls and cash secured puts, over time, that's what the home run is. It's not tomorrow, it's not next year, it's over time. So let's say you invest $10,000 per year for 40 years. At a 9% return, that's going to grow to about $3.4 million. That's pretty solid, right? But if you add just 2 to 4% extra per year, that same $3.4 million, that same $10,000 per year turns into almost $11 million. That's over 3 times more money just by learning how to generate a little bit of extra income with options. So don't think of this like some wild Wall Street tool. Think of it as a way to boost your returns, make your retirement stronger, and do it all while still being disciplined and rational. Now, guys, we use the word trading in our title. We aren't trading. What we're doing here is using this as a tool to generate income. Trading is jumping in and out, doing things quick to make that's not what we're doing here. We are here to use options as a tool to generate income and increase our returns by a little bit. Now, there are a lot of people out there who will claim you can make 10, 15% on your covered calls. That's possible, but the risk is not worth it for me. I have had years where we make 6 or 7%. That was lucky because the market was going down on covered calls. I'll get to that shortly. But I want you to remember, I'm not trying to teach this process of having maximum options income because there's a way to take away from your returns if you try to get too much income. So first off, what is an option? Well, it's exactly what the word is. When you're selling an option, you're selling somebody the option to take your shares away from you at a certain price at a future date. So as an example, let's pull up a stock that I own. Let's pull up Adobe. I own Adobe at $317. I'm going to pull up our options chain on our software. What I'm doing here is I'm picking a date in the future right here. So I can pick all the options dates that our software pulls in. I tend to pick 4 to 6 weeks out. Let's go 4 weeks out, December 26th. Now, if I own Adobe stock, I'm going to go to the calls part because what I'm trying to do is sell a covered call. What makes it a covered call? Well, what makes it a covered call is if you just sell the call, it's kind of naked. There's nothing underneath it, so you could lose a ton of money. If it's covered, it means you already own the shares. So your stock is going to go up. So even if you lose money on the option, you're making money on the stock. It's kind of like a net out. That's what makes it a covered call. I would sit here and say, okay, I have Adobe at $317. I'm going to sell a covered call at, call it $355 per share. So I'm looking at this, and this is on December 26th, so 1 month out. I would get $5 per share for that. So if somebody's going to pay me $5 for the right to take Adobe away from me, the option to take Adobe away from me if it goes above $355 per share. Now, what's that return? That's a 19% return annualized on my money. This is what we're trying to do. We're trying to sit there and say, okay, between $317 and $355, I get 100% of the profit and I keep my $5. If, and this is the if, it goes to $400, I'm losing $45 per option, but on the stock, I made $45, so it nets out zero. But guess what? I still keep my $5. So essentially, it's like me selling the stock to somebody for $360 per share. Now, you might wonder, you might sit there and say, well, Paul, how likely is it to go above 355? That's where we get the delta here. The delta here is pretty much the chance of it happening. It says 0.21. So essentially a 21% chance that it goes above 355 in that time period. Now, why would you want to do this? Well, let's say you thought Adobe was worth $350 a share, and that's what it was worth when it was done. You might be like, hey, I'm fine losing at 355. Or you might sit there and say, no, I think Adobe's worth $450 a share, much further, but the chance of it going that much further that quickly is probably a little bit unlikely. So I want to generate income all along the way. Now, guys, remember, we have this options chain here in our software for that reason. We're also getting it so that you can still hook up your brokerage account in here. So at some point, there'll just be a buy button or a sell button. Now, remember, when you own the stock and you're selling a cover, you're selling the call. You're selling somebody else the right to take the stock away from you. If you wanted to do this, this is not what I'm doing, you would buy it. If you want to sit there and get Adobe above that, all the profit above that, that's where they're going for the home run. Somebody's paying you $5 per share, but if it goes to $400, they made $45 per share, it cost them $5. That's the strategy there. I'm not here for that strategy. I'm here to sell covered calls on stocks I own to generate income for myself. So if I do this hypothetically, if I did this every month and the stock stayed under my strike price every single month, I'd essentially make an extra 19% per year on that stock. Guys, that's not going to happen. You're not going to make an extra 19% per year on your portfolio doing it the way I like to do it. I am more conservative. In fact, what I do is I actually go a little bit further out. I try to find deltas of 15. So I would sell at $3.65 a share. I would get $3 instead of $5 for the extra $10 of spread. But now I'm getting every single dollar of profit all the way to $3.65. So what is the risk here? Like I said before, the risk here is Adobe comes out with some amazing news and the next month the stock skyrockets. I'm capping out my profit at whatever strike price I put there. So what I do sometimes is I don't sell my entire portfolio position as a covered call. I might sell half of it. That way if it runs up, I'm not getting all of it taken away from me. And I might be able to sell it at let's say in the next week, Adobe goes from $317 to $350. Guess what's going to happen? This $6 per share might be now at a $410 strike price. So I can sit there and on this part of the stocks that I did not already sell the covered calls on, I can sell at a much higher price and keep rolling these options. I started doing this strategy in June of 2020, right after COVID. Since then, I've only had a handful, probably 5 or 7 months where I've had a loss in a month. But remember, I am more conservative. I'm not selling. If you go here and say 317 and go to 330, I'm getting $12 per share here. I'm not doing this kind of stuff. That's a 42% chance of the stock being above there. I am selling 10% to 15% chances of the stock being taken away. My goal is to generate just a few percentage points extra per year. I'm not trying to hit home runs because I see the power of compounding. If I can generate a few percentage points per year, 30 years from now, not only am I sitting on a crap ton more money, but then that 3% a year I make in 30 years can cover all of my living expenses and some. That is my goal here. Now, before we move on, I've got to say the last group of students who went through our options class loved it and they crushed it. 55% of them got the options class income out within 2 months of finishing the course. They got paid back with their options. For a lot of them, learning how to properly write covered calls was a total game changer. They walked away with a strategy they could actually use. And like I said, many of them made their money back within a couple of months. That's the power of doing this the right way. So before we go to our options chain, one of the most important things is to know, what is this company worth to me? So I've done my research on Adobe. I like the company. Now it's about saying, okay, what's the right price? So I go to our stock analyzer tool. I do a 10-year analysis. Now I've done Adobe in the past. So let me pull it up and see if I still like the assumptions here. So I did revenue growth of 4, 7, and 10%. All right, second thing, what are my profit and free cash flow? Now for Adobe, as you can tell here, the free cash flow is much higher, which I like, and I'm gonna focus on free cash flow. So I put in 38, 40, and 42%. Now, PE and price of free cash flow. Again, since we focus on cash flow, I'm gonna focus on the price of free cash flow. What is a reasonable price of free cash flow at the end of my 10-year analysis? Well, as you can tell here, one of the first things I look at is returns on capital. This is a metric to say how good is the company. You can tell here that this return on capital is getting higher. That means that as time goes on, they get better at getting a return on the money that they put into their business. That's the sign of a good company. So, historical average for price of free cash flow is 15 or 16. For great companies, I go higher. For bad companies, I go lower. This company is great. So I put in 18, 21, and 24. It's a premium business, high margins, great returns on capital. I want to give them a premium. And then finally, what is my intrinsic value? So what is my 9 or 10% return on the company? So remember what I'm trying to do here. I'm trying to figure out what this company is worth so then I can go sell cash secured puts on this company. So I hit the analyze button, boom. I have a low price of 380, a high price of 820, middle price of 560. So right now, guys, I should want to buy the company today. But remember, I might already have a full position. I might sit there and say, well, I want more of it, but I really want to get a good deal on it. That's where we use the cash secured puts. Let me show you. Since you understand now how covered calls can generate extra income on the stocks you already own, let's flip it. Because if you're just starting out, or if there's a stock you've been wanting to buy at a lower price, there's another strategy that I actually love even more than covered calls, and that's cash secured puts. Let me show you why I think puts are one of the smartest tools an investor can use, and how they can literally pay you to wait for a great stock to go even lower, so you can buy a great stock at a great price and get paid for it along the way. So let's use Adobe as the example again. Adobe's at $317. Let's say I love Adobe, but I want to buy it at $300. Okay, so I pick a date in the future. Again, I like to pick 1 month out. I now go to the puts section of the software. So right to the right of covered calls. But now instead of the ones in green, I'm going to this one, because what's my strike price here? I want to go to $300. Let's say we have $300 strike price. I want to buy Adobe stock 1 month from today at $300. That is my goal. I've done my research. I've sat there and said, if I could buy it today for $300, I would do it, but I'm okay waiting a month. And guess what? I will sell somebody the right to force me to buy it at $300 1 month from now. And guess what? They're going to pay me $10 per share, $9.67. Now you might wonder, well, what's the purpose of that, guys? When you have money in your account, what's it sitting in? Money markets, 90-day treasuries. What are you making? 3.5%? Guys, based on this, you go all the way to the right, annualized ROI. If you did this every single month and you never got the shares, you would make 39.2% on your cash sitting there waiting for the stock to hit that price. Now, let's say you wanted it for $270 a share. Go all the way to the right. It's still a 13% return on your cash. So you're putting your cash, it's securing this put, and somebody's paying you essentially an annualized return, depending on where you're at, of 13%. That's what's incredible. It allows me to take the cash in my account that's making 3.5% and buy stocks that I want at lower prices, generating really high returns on my cash. This is a game changer. So now you might be wondering, what's the catch? Well, here's the catch. It's an emotional issue. But for me, I don't care. The catch is 1 month from now, I wanted to buy it at 300. The stock falls to 250 or some egregious number. Guess what? I'm still paying 300 for it. Yes, I keep my $10, so I essentially paid $290 for it. That's a lot harder than people think to be able to accept. I accept it very easily. But a lot of people out there go, damn, I could have waited and bought it for 250. Yes, that's true. But the whole idea is what I said is if you're not willing to own the stock today at that strike price, then don't sell the put. Because what I tell myself is if it was 300 today, I would buy it. Now I'm telling myself, okay, if I get it and I'm forced to buy the shares, I basically buy it for $290. The $300 strike price minus the premium I got. Now, sometimes it's not going to hit. You just keep the premium. And that's a wonderful way to build your cash position. But at the end of the day, you've got to be okay with the stock falling precipitously. Now, I like to do this on big companies. Why? Because in the next month, what if we find out that Adobe was some major fraud and the stock goes to zero, theoretically? Well, you have to pay $300 for it. You lost $300. Does that happen very often? No, it rarely happens. And of course, this is why we teach in our channel and in our community how to properly assess companies. Look at a company like NVIDIA. There's a lot of questions about, is it fraud? I think they're skirting some of the right rules in accounting, but I think they genuinely are a legitimate company and not an Enron. So I don't think it's going to zero anytime soon, but could it go lower? Let's pull up NVIDIA and see. Let's sit there and look at NVIDIA in our options chain. For this one, the stock's at 180. Maybe I sit there and say, I want to strike 135. But then wait a second. I go all the way to the right here, and I see my annualized ROI is 3.6%. Remember, the bank's not going to give you 3.5% on your money market and give you this money. It's basically going to be one or the other. Some people have told me that their brokerages allow both. Mine does not. So make sure you understand that first. But I look at this going, well, why would I sell this put then? I'm going to make the same amount of money as it's sitting in cash, and now there's no risk of me sitting there and having to worry about it falling below 135. What I'm doing here probably sounds confusing. The first time I heard about it, I was massively confused, and it was 5 years ago. So don't be worried about that. It's all about iterations. It's all about doing this more and more and more and understanding it. The bottom line is covered calls is a way to make money on stocks you currently own. Cash secured puts is a way to make more return on the cash you have, buying stocks you love at lower prices. This isn't a free lunch, guys. There are ups and downs to it. But the point is, if done conservatively and across a wide portfolio, you can add some real extra money. And just 2 or 3% a year for a long period of time will make a huge difference, especially if you're able to sell covered calls in some sort of tax-deferred account like an IRA or a 401k. Because then that money is going to grow tax-free for a very long time. So you've seen how these things work, and you see how powerful it is to be paid. In just a few minutes, I'm going to walk through a strategy that Michael Burry used. Yes, the Michael Burry from The Big Short, and show you how he used options in a very specific, very smart way. I'm going to go over how you can use puts to hedge your portfolio against a market crash. And we're going to circle back to what I said earlier, how a disciplined, process-driven option strategy could mean millions more for your retirement. I'm going to plug some numbers into our retirement calculator and actually show you the difference. But first, I want to tell you a quick story about Steph Curry, because it's going to change the way in which you think about investing, discipline, and doing the boring work, especially when everyone else is trying to chase home runs. So, Steph Curry, if you don't know who he is the greatest three-point shooter of all time. Everyone sees the highlight reels, but what most people don't see is how it started and what he still does every single day to stay the best ever. Steph doesn't begin practice or warm-ups before a game by chucking 30-foot bombs, 50-foot half-court shots. We see those. We don't see what he starts with. Guys, he starts 3 feet from the basket, over and over, perfecting the form, the release, the muscle memory. Then he moves back, little by little, until the three-point line feels like a layup. That's discipline. That's process. Let me ask you this. What if Steph walked into the gym tomorrow and gave me a private shooting lesson? That would be incredible, right? But guess what? If I don't come back the next day and the day after, shoot on my own, train by myself, or even more with Steph, if I don't surround myself with better basketball players to practice with, that lesson won't mean a thing. It's the same thing with options. And just because he taught me how to shoot won't make me a great shooter this very second. I've got to put in the work. If you want to really master this skill, you've got to keep showing up. You've got to stay around other disciplined investors who are doing this the right way. So guys, one thing we know about options is that a lot of people are put off because it sounds way more complicated than it is. That's exactly why we host a quarterly class on options to walk you through these strategies and tactics over and over and over again. The last one we did had such great feedback with students telling us about their huge wins they've had and making their money back within just a few months. The next quarterly class is opening up for enrollment soon. So check the link in the description and either grab your place if there are still spots available or sign up for the waiting list for the next time. We limit our spots in this class. Last class was 30. We might go a little bit bigger this time. But guys, the bottom line is people on the wait list will get the first dibs. Now, guys, as I said before, my goal is to live off my options. Now, I'm not like everybody else out there. I've got multiple streams of income, so I understand how it's a little bit different for me. But I look at it saying, I love investing. So if I can figure out a way to make money in options, I don't have to sell my investments. I don't have to sell any of my real estate, my businesses, my stocks. I can let them ride while I make money and live off of my options. So as I said earlier about the example, let's go to a retirement calculator and actually put in the numbers. Let's say you're 25, you want to retire at 65. That gives you 40 years of work. And I know most people watching are older than 25, but the whole point is to show the magnitude of how incredible this is. Let's say I currently have $0 in my savings, but I'm going to save $10,000 a year. Now, one thing I said earlier was saving $10,000 a year for life. This allows me to increase it. So let's say I increase that by 4% per year. So the numbers are going to be even bigger. And let's say I do 9%. Let's assume just the market return of 9%. And during retirement, I make 7%. And I want to live to the age of 95. And if inflation is 3.5%, I'm looking at all these things saying, what's the money going to look like? Because the great thing about our retirement calculator is it doesn't just tell you how much money you'll have at retirement. It'll show you, can you live the rest of your life accordingly? And that's going to be the big difference here. And let's say my current income is $65,000 a year. And I want to live off that income 100% in retirement. So I never want to see a decrease in my spending. Generate, boom, I have enough for retirement. It's great. At age 65, I'm going to have $5.8 million. Now remember, the reason being is it's more than the 3.4 I said before because you're increasing 4% a year on the money you save. So year one, you save 10,000, then 10,400, then 10,816, et cetera, as they grow. Now, let's go back here. Let's say now that I'm able to add 3% per year to my returns by doing options. This is hypothetical. My annualized returns become 12%. Oh, and by the way, at death, I'm going to have, at the age of 95, I'm going to have $8 million. That's important to know. Now we go back here and we change my returns to 12% while I'm saving my money. And in retirement, I make it 10%, 7% plus the 3%. I hit generate. Guys, look how disgusting this is. I now have $12.4 million in retirement. And guess what? Instead of $8 million at death, I have $156 million. Sounds insane, doesn't it? Remember, it's 75 years later, so that's really worth about $15 million today. But that's the game changer of 3% per year. We have people in our community at retirement who are making 6 figures per year in their portfolio off of covered calls and cash secured puts. It's an absolute game changer, guys. Remember, it's not a free lunch. You need to learn the process. You need to understand why you're doing what you're doing. But guys, this is a game changer for your family. Imagine going from making $65,000 a year, increasing it by 4% a year, and you end up with $156 million in retirement. This is just math. And it's not like I'm telling you to make 20% a year. I'm sitting there saying 7% during retirement, 9% while you're saving changes by 3% a year. Now, back to Michael Burry. It's important to understand this. This is a way to hedge. Now, Michael Burry recently made a bet against NVIDIA and Palantir. You can use puts to do that. Before, we were selling puts to buy stock. Now we want to buy puts in order to force somebody to buy a stock at a higher price because we think it's going to go lower. Michael Burry, he bet against NVIDIA and Palantir. You can also use that same bet to hedge against the market for major falls. So if you have a great portfolio that you love, you don't want to sell them, but you worry about where the market is going, you can use puts inexpensively to hedge against that. That is something we're going to cover in the course. It's actually more complicated than what I've already explained to you, but it is a way to hedge. Now guys, I want to repeat this till I'm blue in the face. If you don't use the covered call and cash secured strategies in tandem with the type of investor you are going to give up a lot of gains. It's absolutely important that you remember this. It's used as a tool to assist you and help you make a few extra bucks. It's not there to drive all your returns. So guys, if you've made it this far, you've already ahead of well over 99% of investors out there. You're learning real strategies that can generate real income. And just a reminder, guys, the seats for the next option class go on very soon, but only people on our options email list will get the invite. So if you're thinking about joining, click the link in the description, get on that list now so you don't miss your shot. In this class, we go way beyond covered calls. We go way beyond cash secured puts. We teach you how to roll options the right way, how to manage trades without panic. We actually do something where if you don't have a full 100 shares, how to do what's called the poor man's covered call, which is the way of getting the same power of a covered call without needing to own 100 shares, which means you can generate income with less capital. And the best part is, you're going to be surrounded by like-minded investors, guys. People running real portfolios. We have some people in this class who have $5 to $10 million portfolios, all writing covered calls, all writing cash secured puts. We also have people with $20,000 portfolios, $5,000 portfolios. Why? Because they know they're on the path to getting to the point where they can generate real income from this. They want to learn it now. So again, guys, click the link below, get on the list. We will see you in the class. And if you're serious about building real wealth, not just learning options, but understanding the full picture, this next video is a must watch. It's our complete investing course where I lay out the foundation for how to actually analyze a company, know what it's worth, and invest with confidence. This is how you pair smart option strategies with disciplined, principle-driven investing. So click the link on the screen and let's take your investing to the next level. Thank you for your time.